Welcome, everyone, and thank you for joining this quarter's quarterly corporate cash briefing webinar. Each day seems to bring a new twist and turn for corporate treasurers and bankers. For example, just in the past few weeks, we've had the U.S. Treasury issue 90-day treasuries at zero interest for the very first time in history. We had the U.S. Federal Reserve duck the interest rate issue. We're seeing lack of liquidity in bond markets. We're seeing emerging market volatility. We have a proposed Trans-Pacific partnership, and it looks like the European Central Bank is going to continue its quantitative easing. We just saw the other day, perhaps through September of 2016. These are just a few of the topics that we'll be discussing today. I'm Tony Carfang, and I'm a partner with Treasury Strategies. As you know, Treasury Strategies consults with corporate treasurers and financial institutions in the area of treasury payments and liquidity. I'm joined today by my Treasury Strategies colleague, Kevin Ruiz, and three distinguished panelists, Debbie Cunningham from Federated Investors, Peter Matza from the Association of Corporate Treasurers, and Roger Merritt of Fitch Ratings. Today we'll discuss the changes in corporate cash levels as well as the issues that we talked about in the introduction. As a quick aside, everyone who's registered for this session, and by the way, I think we've set a record here. We have participants on this call from 52 different countries today. Everyone who's registered, in a day or two, will receive a copy of the presentation and a link to the recording on our Treasury Strategies YouTube channel. Now, we invite all of you to visit the YouTube channel. There are over 50 topical videos and webinars up there. Just go into YouTube, search on the word Treasury Strategies, and our channel should be at the top of the list. If you'd like to ask questions during the webinar, please do. Use the question box in the bottom right-hand corner. We will answer all of these questions in writing to the entire participant group after the webinar. So today, I will be talking about the corporate cash levels. Kevin Ruiz is going to focus on the Asia-Pacific region and specifically the impact for corporate treasurers and bankers on the Trans-Pacific Partnership. We have a number of game changers: central bank credibility, quantitative easing dislocations, liquidity, market volatility, that Debbie, Peter, and Roger will be sharing on the panel. So let's jump right into the corporate cash levels. And as you can see on the chart, in 3 of the 4 jurisdictions that we follow closely, cash is up last quarter. In the U.S., in fact, we saw a $70 billion jump to $2.06 trillion sitting on the balance sheets of corporations in the United States. We saw about a £15 billion increase in the UK, a slight uptick in the Eurozone, and just a slight downtick in Japan. And looking at these trend lines, you can see that the focus is still upward. And on the last quarter call, we promised to take a look at these trend lines to see if we could understand what might be driving corporate cash. And boy, were we surprised when we took a look at this. You can see on this chart the trend lines plotted on the corporate cash graph, and a couple of things about this. The R-squared number that you see in each of those 4 graphs represent the degree of fit, the goodness of fit. So the straight line that we have there, in the case of the U.S., you see the R-squared of 0.94. That essentially means that 94% of the change in corporate cash can be attributed to simply the plot along the timeline. This doesn't imply causality, and we still need to look at that. But as we look across these things, we find 94% of U.S. corporate cash, up in the top left, the variance in U.S. corporate cash can be explained simply by the passage of time. And, that's an incredible finding that basically says that U.S. cash, since the beginning of the millennium, back in 2000, has been growing at $18.5 billion per quarter. Quarter in and quarter out, and that explains 94% of the increase in U.S. corporate cash. Amazing. In the UK, the trend line is even tighter, a higher degree of fit of 0.97, and essentially says UK cash is growing at 6.3 billion pounds per quarter over 15 years. I mean, this is a strong data series, which is really giving us pause. In Europe, the degree of fit is 98%, 0.98, and that essentially says that European cash is growing at 25 billion euro per quarter. Japanese cash, we have a less tight degree of fit, still growing at 1 trillion yen per quarter. We actually, if you look at this chart, we really see two different segments here: the pre-2009 segment and then the post-2009 segment. And you'll see in some later charts we have some things going on here that we need to address. Now, the fact that we have such a tight regression simply against time is not intuitive, and obviously something that we're going to need to study further. If you have any ideas, please share them with us. We really would like to study this more deeply and get our arms around what's happening here. Now, as we look at cash related to GDP, the numbers you see for June 2015 in the U.S., cash remains at about 11% of total U.S. GDP. Eurozone is 23, the UK is 31%, and Japan 52%. All of these numbers are greater by varying degrees than they were at the beginning of the millennium. So we ask ourselves, perhaps that there's a relationship between corporate cash and GDP, or against some other variables that we might want to explore. So we took the U.S. data set and we regressed that against a number of variables that you can see here on the chart. And as it turns out, the degree of fit against U.S. GDP, that is U.S. corporate cash, regressed against U.S. GDP, we have a degree of fit of almost 0.97 or 97%. That obviously is a very strong fit, and we certainly feel more comfortable about that explanation than simply a regression against time. By the way, similar numbers, UK cash against UK GDP, which we'll show you later, is 98%. The Eurozone is 95%. Japan is only 24%. And we have some anomalies there. As we go down this list, you can see some of the other variables that we tested. We looked at U.S. cash as a percentage of the total assets on the balance sheets of non-financial U.S. companies, and we got 0.926. Against the M2 money supply, we get a 0.9. M1 is only 0.78. And against various interest rates, we have almost no trend line at all there. To take this a step further, we looked at the trend line of cash against nominal GDP in each of the regions we looked at. And again, this is giving us a lot of food for thought. Let me explain this particular page. If you look in the top left, U.S. corporate cash levels relative to U.S. nominal GDP, and we plot that out and we look at the trend line, and we have that degree of fit of 96%. The slope is $136 billion per trillion. What that means is for every $1 trillion increase in corporate cash, for every $1 trillion increase in U.S. GDP, 136 billion of that ends up as corporate cash on the balance sheets of U.S. companies. That's approximately 14%. So 14% of the increase in GDP ends up as corporate cash on U.S. corporate balance sheets. Now, if we move to the right, and again, we have a degree of fit of 0.98 here, UK corporate cash against UK nominal GDP, the relationship is 43%, or 431 billion per trillion is the ratio. 43% of the increase in UK GDP ends up in cash on corporate balance sheets in the UK. That's a huge number, and obviously we need to drill down and understand what's causing that. In the Eurozone, the ratio is 378 billion per trillion, or about 37% of UK increase in GDP shows up as corporate cash. In Japan, the slope is negative, and darn if we can figure that out. We're working on that. Again, if you have any ideas, please pass that along. Every quarter we look at the reserve balances of the various central banks, and we can see in the top left, as the U.S. tapers, that the bank reserves at the U.S. Fed are declining. What's declining only slightly, though. There's still approximately $2.6 trillion. What's fascinating here is U.S. Reserves held at the U.S. Fed by foreign headquartered banks represent 44% of total reserves at the U.S. Fed. Foreign banks represent 44%. That's down from 52% a year ago, which we discussed in last fall's quarterly cash briefing. So the reserves of foreign banks in the U.S. have actually fallen, and by the way, that explains all of the decrease. If you look down at the bottom left-hand corner, voila, where'd it go? Well, it's on the balance sheets of the European Central Bank. So as the ECB initiates its 60 billion euro per month quantitative easing program, we see that red line in the bottom left starting to slope upward, and again, a lot of that money, or some of that money, seems to be coming right off of the balance sheet of the U.S. Federal Reserve. If you keep your eye on that red chart, the ECB chart, and think about the Financial Times reporting that the ECB is likely to continue QE at the rate of 60 billion euro per month for the next 12 months, and extrapolate that 400 billion in reserves, we're well up over a trillion euro in ECB reserves, way off the chart. That may be moving in tandem with what you see at the Bank of Japan. Things are flat at the Bank of England. Now, if we put this in the context of regional GDP, total central bank assets in the U.S. represent about a quarter of U.S. GDP, and that's been flat now for a couple of years. On the bottom left, the Bank of England has been flat, again, at about 25% of GDP for a couple of years. The Eurozone, excuse me, the European Central Bank has been under, about in 2012 was over 30%, gets down to 20% a year ago, and is now edging up to 25%, which is very consistent with the U.S. and the Bank of England. Keep in mind, though, at 60 billion euro per quarter for 12 more quarters, we're going to be up in the 40, 50, or 60% range. So we have a lot of money moving around on the books of the central banks, and we're going to be talking more about that later. But next, we'd like to turn to Kevin Ruiz and focus on the Asia-Pacific view.
Thanks, Tony. So we have been talking quite a bit over the last few quarters about some of the issues that are going on with U.S. Major trade partners, and really the situation in the Pacific Rim. As we discussed how we were going to talk about this today, the administration here in the United States announced that they had negotiated through the USTR the Trans-Pacific Partnership, which is still going to be negotiated within the countries that have participated. So the reason we're talking about this is it's an opportune time to really discuss what's going on within these relationships, but also what does that mean to corporate treasurers and to our bank partners. Anecdotally, we've talked to some of our clients about how the changing trade flows are going to affect their operations and thus their cash flows. We work a lot with clients that have exposure in Asia or are based in Asia on trade visibility via the use of technology, negotiating credit facilities across the Asian continent as well. So to talk about the TPP, this is currently it's a 12-nation regional agreement, 40% of the global economy. And I want to point out that the administration has actually had a run of success here in the United States as far as trade negotiations go. This administration just won fast-track trade promotion authority, and now they're moving on this Trans-Pacific Partnership as well. There's always going to be concerns about what a trade agreement means in terms of flow of jobs, protection of things like intellectual property, all that kind of stuff. But overall, this is going to be engrossed and brought into legislation in some form or another. One point I'd like to make is that 10 years ago, we probably would not have looked at this agreement in as great a light as we do today, because we were expecting the Doha round to become much more global in nature. But right now, in the global situation that we're in, the Trans-Pacific Partnership looks like a pretty good deal. Now, there's a few things to point out here, which is why we're kind of talking about this today. The biggest trade partner that the United States has, and one of the biggest parts of the global economy, China, is not involved in the Trans-Pacific Partnership right now. That may change because of the open structure, the open architecture of the TPP, but right now China is not involved in this agreement. And I want to point out a few other things. Overall, the volume of global trade is actually contracted. If we look at recent news, you can see that the largest contraction since the global financial crisis happened this quarter. It was a 0.5% contraction, which is very unusual to see. We see slowdowns in Asia. The growth rate right now is looking between 5.8 and maybe 6.5%, which is well below the 8% growth that has been seen in recent years. So there's concerns as the administration goes to negotiate the TPP. There's concerns about what the domestic audiences within these trade partner countries are going to look, are they going to look kindly on this, or there's going to be resistance? That's down the road. So moving on to the complications for corporate treasurers, what does this mean? You still see FX volatility. You still see, increased exposure as our corporate audience increases trade globally. You'll see, some of these exposures, increasing. And that means increased business and supply chain exposure, increased operational exposure, and increased country and political risk exposure. Within the domestic markets of all these nations, there are issues that are going on. China's got a slowdown in its exports of almost 5% year over year. There's a lot of local debt within China that there's discussions on how that's going to be addressed, and there's an overall lower demand for raw and intermediate goods that are being driven directly by that slowdown in China. And that may mean less to some corporates than to others. If you are a primary commodity producer, obviously you know what that means. For other entities, it varies. But overall, what that means is there's a lot of volatility in the marketplace, which means there's a lot of volatility in FX exposure, and the TPP may help smooth some of those rails, but it's not going to be a solution. We can look at Japan and look at what's going on with quote-unquote Abenomics, their approach to monetary easing, the government deficit spending, which in some part goes back to what Tony talked about, as well as a greater amount of business deregulation there. They have a huge domestic debt of over 250% of their GDP. And even looking at the United States, we have an election year. The Fed rate liftoff was put on hold for this year. I personally lost a bet on whether that would happen this year or not. So there's a lot of questions around what's going on here, as well as some of the ratings downgrades that are going on here in this country. So what does that mean for corporate treasurers? And my message to you all is that, not taking any risk and pulling up the drawbridges means you're not doing business. You need to have visibility and intelligent forecasting for making smart, risk-informed decisions about, where your operations are, where you're going to park cash, all those sorts of things, but also greater attention to where your global cash is and where those currency positions are. A greater attention to FX volatility, a more robust hedging strategy. That means visibility to cash. That means a greater use of technology. That also means deciding on your risk exposure, deciding on, how you want to perform hedges, where you want to do something more vanilla, or you want to get into something more exotic, as well as the natural hedges that occur, the business hedges that occur just by having a global presence. But also really considering, and this is from a treasurer's perspective, considering the business strategy. What's driving that exposure? and then what do you need to do to hedge against that? And again, we're working with a lot of our clients in Asia, specifically in Japan, but also in China, on improving trade flow visibility, an understanding of what the TPP and other agreements mean to tariff changes, and then the credit facilities that need to be negotiated, so on and so forth. So that's all I had to talk about on the corporate focus on Asia Pacific, and I'll hand it back over to Tony to continue the discussion.
Thank you, Kevin. Well, obviously, a lot going on there. This has been great for Treasury Strategies as we work with a number of our clients in dealing with Asian trade flows. But now let's move on to this quarter's game changers. And as we were preparing with the panel, we identified 4 specific things we'd like to talk about today. Central bank credibility, quantitative easing dislocations, global market volatility, and bond market liquidity. So why don't we begin? First question I'd actually like to start and direct to Debbie Cunningham. And by way of background, shortly after the Fed decided not to change rates and lift off from a zero base, I was attending a luncheon of corporate treasurers, and the host opened the luncheon with a toast. And he lifted an empty wine glass and toasted to the emptiness of Federal Reserve policy. Now, that might have been a little dramatic, and I'm not going to editorialize on that one way or another. But Debbie, what has all this on again, off again done to the credibility of the Fed and central banks broadly?
Thanks, Tony, and certainly. I think I probably agree with that toast. And in the course of the last decade, the Fed has tried very hard, first through the Greenspan Fed, then through the Bernanke Fed, with improving their communications and improving the telegraphing of changes and monetary policy moves that they would be making, so that in fact the market wouldn't be surprised. We've done an about face at this point because they've continued to provide communication, certainly over the course of the last 2 weeks since the non-move in mid-September. They have provided a ton of communication that basically says, oh, we'll be moving before the end of the 2015 timeframe. But I certainly don't believe that there's many creatures on the planet at this point that actually believe what they say. They're believing what they do, and what they do is absolutely nothing. The empty glass, as you're alluding to the toast, Tony. So I think they've damaged the credibility of Fed communication in a way that is going to take a long time to build back up again, if it ever does.
Interesting. So, Peter, from your perch at the Association of Corporate Treasurers, where you have membership around the globe, how do your members view this? Is there a frustration, or is there just a sort of a grin and bear it kind of attitude?
It's an interesting point, Tony. I think there's an argument, of course, that what business wants is stability and certainty. Some elements of that predictability going forward 6, 12, 18, 24 months, however long it may be. From a corporate treasurer specific point of view, you could argue that for investment grade corporates, for example, borrowing money is still cheap, full stop. Goes to a little bit to explain some of that rise in cash that you were talking about at the top of the broadcast. I think underlying that, though, and the strategic part of a corporate treasurer's role in helping business define what business it's in, what areas of activity it's in, what the risks are associated with that. The question then becomes is, what does this do for investment analysis? How do you sit there and say, well, we want to go into a new market or a new product or a new sector or a new line of business operation? what is this telling us about the way the world works? And backfilling, if you like, from the fact there's an awful lot of money sitting in banks not doing anything, you could argue that corporates are actually still uncertain about the economic environment, and central bank uncertainty from the point of view of saying, well, we might, and then saying, well, we're not going to because the circumstances haven't changed, probably contributes a little bit to that. Slightly contradictory in some ways, because you could then argue, well, which comes first? The inability of central banks to make up their mind, or the fact that the economic environment doesn't force them to do so. I think from a corporate treasurer's point of view, you would still be saying to your board, if the opportunity out there remains for you as a company, if you haven't looked at your balance sheet and said, are we in the right place with it, or are we doing the right things with the cash, you may still take advantage of where the capital markets are. There are still corporates in, if you like, the crossover space between investment and speculative grade who are trying to take some advantage of that, however modestly, in hybrid securities and those types of issues. But generally speaking, I don't think it doesn't look healthy that, well, our central bank governor in the UK, Mark Carney, has decided the most important thing for him to talk about is the impact of climate change on business growth and economic stability, which you might think is slightly odd. He makes a valid case to say, well, it's all part and parcel of economic growth. I think people would much prefer him if he stuck to his knitting rather than went slightly off the point. The numbers don't lie, do they, though? People are sitting on an awful lot of money, and they're not doing a great deal with it. There's a simple fact with that.
Fantastic. So that actually leads in, and I'd like to direct a question to Roger. Following the Fed's decision to not raise interest rates, many of the pundits and many of the economic analysts were saying the problem with that decision is that simply exacerbates the economic dislocations or the asset bubbles that are being formed or capital being misallocated. As you at Fitch Ratings, watch the global markets and rate the credit quality of instruments and institutions around the world. What do you see in terms of dislocations? Is money going to the wrong places as a result of central bank policy?
Yeah, Tony, I think it's, I think it'd be hard to argue that that there aren't distortions in the marketplace because of the Fed's long zero interest rate policy. I think, we are in uncharted territory. We published some research a while back that looked at prior interest rate cycles going back roughly 40 years. And prior to now, the longest period of sustained easy money policy, both in terms of, the magnitude of the easing and the duration of the easing, was roughly 17 months, or call it a year and a half, if you will, which happened back in the early 90s. Now, compare that to where we are today.
By the way, as I recall.
Yes, I think you're right. So compare that to where we are today. We've had zero interest rate policy in place for nearly 7 years. So that's really quite unprecedented. So, I think the clear takeaway is it's hard to know how the markets will ultimately reprice once we start to see the Fed raise rates to more normal levels. So I think there was a famous quote from one of the Federal Reserve chairmen who said that it's the job of the Fed to remove the punch bowl just as the party is starting to warm up. So, this party's been going on for quite a long time.
Yeah, I think we're already in the morning after, aren't we? But Roger, at the same time, you have quantitative easing now. You're really full bore in Japan and in Europe. I guess that would exacerbate your points. Then, is that right?
Well, I think it does add to the distortions that take place in the market in terms of just asset flows and overall market liquidity. Yes.
Okay, great. Well, Debbie, as Chief Investment Officer at Federated Investors and overseeing hundreds of billions around the world, how does this impact the way you look at institutions in different markets and your potential investment opportunities?
Well, certainly we have to look at what the intervention by the central bank is doing to the market, whether it's helping from a liquidity perspective, which is generally not the case, or harming from a liquidity perspective, which may or may not be the case, or whether it's a neutral. You know, just looking at what's happened here in the U.S., because that's, you know, the biggest state case study so far. You know, the balance sheet of the New York Fed is, you know, about $4.5 trillion in size, when the normalized balance sheet in other situations is around $1 trillion. So we have an excess of about $3.5 trillion in what are high quality, very liquid assets, treasuries, government agencies, and government agency mortgage-backed securities that are not playing a part in the market any longer. They're not out there for people to buy. They're not out there for people to sell. The Fed is making them available through the RRP program, the reverse repo program, on a temporary basis, obviously overnight or at quarter ends on a term basis. And that's certainly helpful for making sure that the liquidity that's needed at those periods of time is there. But ultimately, it's taking away some of the normal functioning of the marketplace. And when you look at some of the dislocations, you know, it's in the you know, some of the highest quality, most liquid areas. Repo would be one of them. Treasuries and agencies would be two others. The bank marketplace, bank CDs, bank paper would be another. So there are certainly dislocations that are out there that are causing our investments and our funds to deal with counterparties that are many fewer than has historically been the case, and in some cases non-traditional versus the typical counterparty of a bank or broker-dealer.
Thanks. Well, what a great overview there. I want to move down to the bottom left box and address a question to Peter regarding the global market volatility. I know you do extensive travel and visiting your members all over the world. You know, we're seeing volatility in exchange rates. We're seeing wider spreads on securities. I think we're seeing some jurisdictions trying to build liquidity, lots of capital flows, concerns about emerging markets, potential inflation, commodity price issues. Could you comment on the volatility that you and the ACT's members are dealing with day in and day out?
Yeah, I think to an extent, volatility is often seen as a dirty word, and in most reporting of it, it's used in the context of financial assets and financial markets. Foreign exchange perhaps being a better example of it. Having said all of that, a responsible corporate treasurer in situ will be saying to him or herself, okay, as your slide said, I'm in business. Business means risk. Therefore, as a corporate, what risk are we prepared to accept? What risk do we want to mitigate? What risk do we need to transfer? What risk are we naturally accepting within our business? What's our risk appetite? How do we manage that process? Now, volatility in financial markets sometimes has an indirect impact, of course, on corporates. It depends on where you are. In the UK, for example, just to give a simple example, it has an impact on corporate pension funds potentially in their valuations, and therefore what corporates need to look at in terms of supporting those pension funds. In parts of the world, such as the Middle East, where they don't have that as an issue, they look at other aspects of volatility. They may look at commodity price. I was mentioning earlier on in our conversation, you look at Saudi Arabia, heavily dependent on the oil price. Yes, they have huge reserves, but even there, they're beginning to think about how do we manage our liquidity better such that we can fund the very large public account deficits that we have in terms of our public spending on our infrastructure or on our social programs. And there's certainly, if you could talk to bankers and corporates in the Middle East region, certainly in the Gulf region, there's been a reduction in market liquidity generally in banks, and what that's meant is a certain squeeze on some lending and a certain squeeze on some borrowers in terms of the prices they're having to pay. Good treasuries in well-run organizations have some plans or policy, at least, to how they deal with that. You can't deal with everything when you wake up in the morning, but you can deal with some of that. We had a successful conference in Asia back at the beginning of September in Hong Kong, I would say, and there, on the one hand, you have a certain amount of, obviously, your currency volatility, but on the other, you're dealing with such a dynamic change of the business environment in China, as you mentioned, that actually they're embracing volatility in the sense of this is about growth and development. And to the extent that we want to be associated with that and our organizations can benefit from that, we'll accept it, we'll take it on board. So I think it becomes a mixed picture as to how you define volatility. In itself, it's not necessarily a bad thing, and nor is it a debilitating thing for a corporate. It depends upon the where they start. You can argue that by the same token, there's been no volatility at all in base interest rates because they've been kept low. Has there been volatility in spreads at investment grade level in the capital markets? Broadly speaking, not. So you could argue there's a great deal of volatility that's not there, and it's those things that are attractive to market participants but don't necessarily figure onto the agendas of regular corporate treasurers in their day-to-day risk management. I think the other last point I'd make on this is global market volatility. Sometimes, if you look in the European context, clearly we have some political volatility in Europe at the moment in terms of political parties and elections, migrant crisis, potential for further blow up in the Middle East, the sort of the usual geopolitical stuff which comes around every other week. That's a different sort of issue, and you may have to deal with that on a localized or a regionalized basis. But I think in terms of if you're looking at financial indicators, some are volatile, some are flat. On balance, sensible treasurers will have planned, or at least be able to deal and talk to their stakeholders and say, we have a good idea of what we're doing here, but it really all comes down to the fundamental point. What risk does your organization want to accept? What appetite do you have?
Great. So transitioning over to Roger then, as you view all the institutions that you rate, how does volatility in the markets impact your judgment calls on ratings?
Well, you know, Tony, one of the areas we've been focused a lot on lately is just bond market liquidity, which I think is really a really key issue that regulators and certainly market participants are focused on. You know, we've seen tremendous structural changes in the markets since the financial crisis, and in no small part driven by regulation. And you know, so I think one of the concerns that we have and that the market is focused on is, you know, whether these structural changes have just resulted in markets that are fundamentally less liquid, and that obviously has implications for anybody who's trying to manage cash or is regularly trying to access the capital markets. We did a survey last year of select asset managers, and you know, one of the questions we asked was, you know, are the markets less liquid? And the answer was uniformly or almost uniformly yes. And so you know, so I think one of the concerns is, you know, where is the liquidity coming from today? And you know, it seems that increasingly it's coming from the asset management industry itself. The assets held have AUM held by bond funds has grown fivefold since 2009. So, so I think the concern there is, you know, do these managers have the intrinsic liquidity to manage a period of outflows? We've done research that shows that that flows are strongly correlated to returns, and we've also seen that there's a high correlation between the size of a bond issue and its liquidity, and we're not the only ones to comment on that. So I guess the question is, you know, are we going to see greater volatility going forward than we have in the past? And you know, I think the answer is, you know, it remains to be seen. But I think in certain segments of the credit markets, emerging markets, high yield in particular, I think the answer is you know, maybe yes.
Tony, can I add just a quick point here? There's another element to this, certainly from a European context. our old bugbear financial regulation, things like MiFID II, are clearly going to have an impact on the marketplace. And in particular, I'd just like to say that in the context of corporate bonds, or non-financial corporate bonds, traditionally in Europe, there's been very, very little liquidity, if any, whatever the size of those transactions. So to the extent the liquidity is drained away, it's hardly been noticeable. And what have our friendly regulators done? Well, they've made it even harder for secondary market traders to hold illiquid stock by putting higher capital constraints on illiquid stock, which has the precise impact of making the stock, guess what, more illiquid. So
that's right. I'm
not quite sure it's a game changer because it's always been there, but it's not going to get any better in those circumstances. Now, I expect Debbie's probably got in the same problem. They go and try and find inventory from dealers, and dealers say, do you know what, it's too expensive for us to hold inventory. So unless we can find a way in which the money can be made to go around that liquidity issue, certainly in the corporate marketplace, in the secondary marketplace, is going to become even more of a, if you like, even more of a non-issue than it is already.
Well, and I know that Debbie has a lot to say here, but before I turn it over to Debbie, Roger, you said one thing that absolutely scares me, and that is that asset managers are currently the primary source of bond market liquidity. We all recall that in 2007 and 2008, as funds were fleeing asset-backed commercial paper, auction rate securities, enhanced cash funds, and whatever, money market funds were the primary source of liquidity into the marketplace until the day that they decided to no longer provide liquidity to Lehman Brothers, and they got tagged with the blame for the entire financial crisis, even though they were the last man standing, the money market funds. I certainly hope that that's not what's shaping up here in the bond market. So with that ominous thought, Debbie, I mean, you're in the market every day. What kind of shifts in liquidity are you seeing? You know, we know dealer inventories are down 80%. That means that spreads must be widening. What the heck's going on?
Well, certainly there is. The bond markets have always historically been less liquid than the equity markets. I mean, it's just been historically a buy and hold asset class compared to the equity side. So always much less liquidity along those lines. Having said that, I think you know, today's market from a bond perspective versus, you know, historic markets from a bond perspective probably isn't all that much less liquid. It's just who's making the liquidity. And I agree with what Roger was mentioning, that the traditional counterparts, traditional broker-dealers who have historically held inventory and made markets are not as willing to do so today because of the concerns that they have about what their own balance sheet looks like and the capital charges that might ensue if they, in fact, did end up holding, you know, securities as a market maker over some period of time. So I think the market makers are less prone to be active in the marketplace, but that there are larger funds, larger products, larger buyers, and that those buyers are not as much buy and hold as they have historically been. They're seeking, you know, more on the active return side of the equation, and as such, very active in the market on a daily basis. Bid-ask spreads are definitely wider. You know, spreads from a general perspective on a credit basis are a little bit wider. I guess I could say that when you're in a bond fund versus an individual bond, the liquidity is much, much higher just because of the diversification, the pooling of the assets from a huge number of clients. So that's one way of kind of getting around, you know, some of the less liquid aspects of the individual bond issues. But certainly, you know, it's a part of the market, it's an aspect of the market that we will continue to need to monitor to make sure that, you know, the charge from a perspective of being able to provide liquidity from bond funds, fixed income funds, you know, on a T+1, T+2 basis is certainly one that will need to continue to be challenged and reviewed given, you know, what market conditions currently would be. And I think they're not as bad as some of the press make it out to be in the context of where the market has been historically, but by the same token, they're nowhere near what you would have if you had, you know, sort of if you were looking at other types of markets like the equity market.
Interesting. Now, Peter, you alluded to Eurozone regulation, and we've seen some things in the past couple of days, like the proposal for a European capital markets zone and things like that, which seem to be, although it's a government solution, it does seem to be a recognition that perhaps some of the regulations have gone a bridge too far. Are you picking up on that at all?
Yes, we certainly are. We've been involved in some of those discussions already, and there'll be more ongoing. And I think the idea of the Capital Markets Union has been there for some time, although you would argue that if an organisation founded, I don't know, 50 years ago on the basis of free movement of capital, there already ought to be a Capital Markets Union. The fundamental problems still remain. You have a localization of issues in terms of regulators giving up influence or not wishing to do so. You have some issues in terms of what people consider to be good or otherwise not good practice, depending upon what their marketplace is used to, for example, and what the level of of issuance they're experienced. You've obviously got Eurozone and non-Eurozone within the EU as a whole. And then you've got these, what would appear to be counterbalancing requirements for financial institutions to hold more capital against things, and then by response, when they stop holding more of those things and they don't need the capital, the marketplaces for those things start to decline, and then regulators and politicians go, well, hang on a minute, how's finance going to get out there? Now, the other side of that is, do those large corporates sitting on those huge balances, are they obliged to spend that money into supply chain practice? Well, there's plenty of people that suggest they should. Are they spending it on M&A, whether it's not being seen? I think there's a number of issues there in that regulatory field that have those knock-on effects. So whether it's Solvency II in the insurance industry, or whether it's MiFID II across a variety of other areas that has impacts on various people, whether it's still some of the rumblings of derivatives of regulation and so on, or don't get me wrong, there's some good intentions here, and there are certainly some interesting and practical and useful ideas, and the fact that they are going around the community, the business community as well as the financial community, is a good thing. I think the question is do you have regulators competing internationally and then between regions internationally, so US or Europe or elsewhere? Is that a good thing? Clearly not. Does it happen? Yes. Will you get arbitrage? Of course. So I think there's a number of those sorts of issues that we'd like to get managed or approached in a I hesitate to use the word, but in a holistic way rather than a issue by issue or subject by subject way. But let's be positive and say there are some certain signs that recognition that the real economy needs proper finance is at the top of politicians and regulators' working lists.
Boy, and that's an excellent summary. The real economy needs proper finance. So this week, as we mark the 7th anniversary of the TARP program in the U.S., $700 billion going out to provide liquidity to banks, it's hard to believe that 7 years later we're still talking about the need for liquidity in the marketplace and for the central banks to gain credibility. I would love to thank our partners and sponsors, Debbie Cunningham at Federated Investors, Peter Matza at the Association of Corporate Treasurers, and Roger Merritt of Fitch Ratings. As usual, your insights are unparalleled. For those of you online who have questions, we're going to keep the screen up for a few more minutes. Feel free to answer or to ask any questions in the bottom right-hand box, and we're going to respond to the entire set of participants in writing. We'll be sending out the deck and the link to our Treasury Strategies YouTube channel, where you can download this entire webinar. Please visit our sponsors' web pages, and we look forward to seeing all of you again on Thursday, January 7th, which is the tentative date for next quarter's quarterly cash briefing. So Debbie, Peter, Roger, Kevin, thank you all very much, and to all of you who tuned in, thank you all very much, and good liquidity.